what does your vision for the future look like? What does a world on not just a sound money standard look like? Because we could have a world that has that, but where there is still complete and perhaps more strengthened US dollar hegemony because we've missed the medium of exchange part and we've just focused on the store value. What does it look like in your view?
Yeah, that's actually why these things are incompatible over a long time together. So in one system, Bitcoin, if it stays decentralized and secure, then all prices fall relative to it. To stay decentralized and secure, it requires being a medium of exchange. These are the tools, these are the early indication tools or protocols that are going to ensure that it remains decentralized and secure, ensure that it moves into a medium of exchange. Without them, it would be highly likely that it would get captured, because through essentially what all you would do is US dollar to gold, US dollar to petrodollar system, US dollar to Bitcoin, nothing would have changed. And that and I would say the vast majority of even Bitcoiners today, because the Bitcoin, there's such a deep hole, are still measuring Bitcoin in price in the US dollar. And so I saw one of the questions that'll help people understand what I'm talking about here, and we'll try to kind of look at it from both systems in the question, but it had something about the financialization, right? Something, and help them to understand pricing in Bitcoin. And so over the last 30 years, everything you've ever known, and most people have made all of their money, not really made money, the entire wealth of the world is an artificial construct of extracting from some people, giving it to the other through an instrument of financialization. And through that financialization of a lens, then it would look like houses have gone way up in price because they would act as a store of value, because cash couldn't act as a store of value, because it was an inferior store of value. So you'd have to find other stores of value. Those stores of value became houses, those stores of value became stocks, and you start getting higher and higher bid prices on all of these stores of value that reinforce, instead of a house being a utility where you raise your family, it becomes a store of value. And then everybody races into the store of value, because if they're not in the store of value and only in cash, they're getting destroyed. So everybody goes and makes the same trade, pushing it up higher and higher and higher, further away from its utility value as a store of value. And then enter Bitcoin, and Bitcoin is repricing all of those to their utility value and or the marginal cost of production, everything on the planet. So if you measured both those, this house, I've said that before, was $1.4 million 4 years ago. Now it's $2.1 million Canadian pieces of paper. In Bitcoin, it was 300 Bitcoin 4 years ago. Now it's 22 Bitcoin. In 4 years, this house will be 2 Bitcoin. And so all Bitcoiners are facing the same choice. When do I want to buy this asset? Because a lot of the Bitcoiners want to buy a house because they've been so locked out of the housing market because everybody's racing into it, leveraged against it. And so they can't wait to spend their Bitcoin on a house. And everybody is able to make that choice whenever they want, but it's going to keep happening, right? In 10 years, this house might be 0.1 of a Bitcoin. And so if I had a whole bunch of Bitcoin, as Bitcoin is repricing this into the house to its utility value, I can make a choice anytime to be able to use my Bitcoin to be able to price my house. If I price it today, what I'm really paying for is a way overpriced house, because as people see it as a store of value. And it's a really bad store of value compared to Bitcoin. Really bad store of value. Now, if you want a house because of your family and your neighborhood and everything else, you should do that. You should do whatever you want to at your choice. But if you're in the store of value that everyone else is in because it's the only game in town, there's a new game in town.
I think that is it's a tough pill to swallow. It's going to be for a lot of people. But I think it's a very good one to swallow, because that's what your house should be, right? Like, it should be where you should be buying it because you say, well, I want to live here with my family. I want to raise my kids here. I want to make memories here. I want this because of the utility that I get out out of it.
100 years ago, houses look different. They look like a neighborhood of young families, that was a community. Houses don't look like that anymore, because all over the world, in other currencies that are debasing just as fast or faster, they're trying to get into your stores of value too. So this is how. So you have a global phenomenon bidding up houses far beyond the utility value as a store value, and all of the debt underlying that is contingent. It's a contingent liability against the entire system. So it has to keep going higher because you're having to debate. Because if that debt became due, if you didn't inflate that debt away, it's over. The whole thing crumbles. And so those assets are a core part. And so is commercial real estate, and all of these things are interlocked into inefficient stores of value, really terrible stores of value, but they were the best thing. They were the best stores of value for the last 30, 40 years. So everyone rushes into that trade thinking that I have to have a house to protect my wealth.
Well, and the sad thing is too that if you look at like the compound annual growth rate of the money supply, depending on what you look at, like, but even just in the US, you're looking at like high 6%, close to 7% for the CAGR of the money supply, which is also over a longer period about what the housing market increased by. It's about what the S&P increases by. It's about what everything that is supposed to be a benchmark or a good place to store your value increases by. That means it's not increasing. You're just treading water.
Worse, it only captures half the equation. The other half of the equation that's stolen from you naturally is the actual deflation rate that should be in a house. The actual deflation rate of all the materials and all of the other things that as efficiency. Like, think about what a lumber mill looks like today versus what it looked like 100 years ago. Think about what any mining looks like. It's all automated, completely almost automated. And these things are highly efficient operations that would mean all of the different products relative to the house should be far cheaper, not just neutral. So prices should have fallen in all of it.
And I think that is perhaps one of the most difficult things for folks to understand, even if they may understand that, okay, inflation is this bad thing and I'm feeling poorer because my purchasing power is dropping because of inflation. They're not actually seeing the extent of the rot that is there. They're not actually seeing the extent of the theft, which is you're not stealing, as you said, you're not stealing from the baseline. You're stealing from negative. You're stealing from deflation and then making up for it and then